Hey everyone, Dividend Kings are one of the best places to go to find durable, battle-tested dividend growth stocks because by definition a dividend king is a stock that has grown its dividend for at least 50 years in a row, which means that it has been growing dividends for longer than I personally have been alive, and probably several of you in my audience have been alive, and even if you're older than 50, it's the great majority of your lifetime and likely at least close to your entire adult lifetime. And of course, that means they have gone through, these companies have not only survived, but have continued to grow their dividends through all sorts of environments, terrorist attacks, economic crises, prolonged periods of economic stagnation, inflation, low inflation, wars, you name it, these companies have been through it. And so these typically have some kind of moat. In fact, almost every case they do have a moat. They have good management, they have strong balance sheets, they have a very prudent capital allocation policy that combines growing the business and defending its durability and its competitive positioning with also returning capital consistently to shareholders with dividends. They're companies that consistently create value for shareholders because if your dividend grows every year for 50 years, without a doubt, you've likely grown value per share, all while maintaining a strong balance sheet. So this is a good, quick shortcut to be able to find these companies. And so I'm going to use one of my favorite tools, InvestingPro. I just go to the Ideas tab. It tells you about all kinds of different companies that meet different qualifications. So here's Dividend Champions. These are stocks that have grown their dividends for 25 straight years. So it's almost like a Dividend King. And I have my own list of Dividend Kings that you can actually get for free. If you look at the link in the video description as well as the link in the pinned comment, there's a Dividend Kings link there. You can get those for free. And here I'm going to just do a quick filter to find. So first I'm going to look at most undervalued. Now I'm looking down here and I see, okay, UGI is a good division of Aristocrat, but it's not a Dividend King. Becton Dickinson and Company is a Dividend King. So it's the most undervalued based on fair value upside from InvestingPro. So I'm going to take that. And then I'm also going to look for the highest dividend yields because obviously I like yields. I'm an income investor. I run an investing group called High Yield Investor, so I like high yielding dividend stocks. So here's Altria Group, 7.3%. They are Dividend Kings, so I'm going to look at them. And so I'm going to compare these two companies today and decide which one is the better value today, the one that's the most undervalued or the one that's the highest yield. In other words, which one would I buy and or perhaps which one should some others want to buy. So I'll look at these two companies, Altria and Becton Dickinson. So Altria, first of all, is a company that manufactures smokable products. I personally strongly discourage you from smoking. It can cause a lot of damage. I have relatives that have suffered cancer and even died due to smoking. But the company itself has obviously been very effective because of qualitatively, smoking is very addictive, and so people will smoke regardless if it's a recession or an expansion or whatever's going on. And so their revenue is very, very sticky. They have a very wide moat. And so as a result, they've been able to grow prices consistently, which means that even if their volumes are shrinking, which they have been quite rapidly recently, they can continue to grow profitability per share and thereby grow their dividend per share. Hence why they've been able to grow the dividend for over half a century. And so let's take a quick look at this one here. We see here that it has a 7.3% dividend yield, which is quite attractive. And we also see that the company has great financial health. So it's a pretty healthy business. We also could take a quick look here and see where it is relative to its market range. So the current price is $58.69. We see that's pretty much in the middle of its 52-week range. So based on that metric, it doesn't look particularly undervalued or overvalued. We see the Analyst price target consensus is at $62.58, so there's some mild upside. And we see the InvestingPro product of 15 models, which range from $47 to $83, gives us $67.33. So it's even more undervalued relative to that, but not exceptionally undervalued. In fact, we see here that the average fair value for InvestingPro puts it at $67.33, so there's 14.7% upside. And we see that this brings with it low uncertainty. There's a high degree of conviction in this fair value estimate based on InvestingPro's internal models. Now, if we look at the dividend, we can see indeed that it has grown its dividend consistently, and not just token amounts, it actually grows at a pretty solid clip, and its payout ratio of 77.93% is pretty stable. Now let's look to the earnings estimates. We can see moving forward, what will analysts expect? And you might not be surprised to see this because of their declining volumes in their core cigarette business. Their growth is slowing, and analysts are expecting that with just 2.8% earnings per share growth, followed by 3.6%, 0.2, 4.5, and even negative 0.7 out in 2030. And we can see the variance in the projections here as well. And so clearly, and you can also see the number of analysts who do it, so that can kind of increase your degree of conviction. So these are only 1, 1, and 2. So these ones, lower conviction in those because not very many analysts are covering them. But here we have 8, we have 13, and so these are much higher conviction expectations for what their growth rate is going to be. So it looks like it's going to be around 3% for the next few years, and then likely even lower in the years following that. So the growth is going to be barely keeping up with inflation. But the good news is we get that nice high single-digit yield that sets us up for potentially a decent total return picture. We already looked at these models, but this one can give us individual models. So I think, for example, DCF growth, that's a pretty good model, $78.80. That's a pretty good valuation relative to here. $71.93 for the EBITDA, and then the revenue, $63. So it's less undervalued based on that. PE multiples, it's quite cheap for given where its PE multiple is. And so, yeah, these all give us some conviction. This one's probably undervalued. Now we can look at Becton Dickinson and see this one. Now this one is a medical supply device, laboratory equipment, and diagnostic products for healthcare applications. They develop it, manufacture, and sell it. So they're a healthcare company. And we can see here that they have good performance, but not great performance when it comes from financial health. We can also see that on their valuation range here, based on InvestingPro, okay, they're at 194.48 right now. They have significant upside, 35.7% upside to the 263.87 multiple valuation. However, the models are wide-ranging, and so based on some models from InvestingPro, it is undervalued. We see the same with the analyst target. It is undervalued relative to the analyst price target, but there is quite a wide range there as well between the upper end, which would be very, very undervalued relative to the upper end, but it's slightly overvalued based relative to the low end of analyst targets. Now it's 12 analysts, so there's a high degree of analyst coverage on this stock, and so that's where it's falling in. And again, the market range is much closer to its 62-week or 52-week low than its 52-week high, but it's not, completely near there. So it does look somewhat undervalued. Let's look at the dividend history, and we can see here again some strong dividends over time. 55-year dividend growth streak, very quality dividend payer. Let's look at earnings projections. Now, first, let's see, what is the dividend yield? It's 2.15%. So not terribly high yielding, still yields about twice what the S&P 500 yields, but definitely not a high yield stock like Altria is. All right, so the earnings projections here, we can see from analysts, again, high degree of confidence for next year and 2027 because of the number of analysts covering it, 14 and 14. Looks like pretty solid growth. Now, not so great growth over this next year, 3.7%, just barely beating inflation. But then in the outer years, it's really strong, 6.5%. It's accelerating. And then even with 5 analysts covering, that's still pretty good conviction, 8% expected for 2028, and then 13% for 29 with only 2 analysts covering it, and then 6.5% for 2030. So definitely much higher growth rates expected for Altria. And then for Altria, and we're seeing an accelerating pattern here, which is another really nice thing to see. The market likes that. If they see accelerating growth, they tend to reward it with a materially higher valuation multiple once it proves that it can do that. Now let's look at some of these individual ones like we did last time. Very undervalued relative to the DCF growth, very undervalued relative to the EBITDA. Also very undervalued relative to the DCF revenue one. Let's look at price to earning multiple, also very undervalued relative to that. So we can see why this one was rated as undervalued one. On some of the best multiples out there, it is very undervalued. Okay, now let's do a comparison. You can compare it to peers if you want, and we can see here that in a sector that's mostly fairly valued, there's some bargain undervalued, it is very undervalued. So this sector is clearly not in favor per se right now, yet BDX looks quite undervalued. But now let's look at it compared to Altria. So we can delete all of these, And we can just type in Altria Group. And we can take a look at it here. So we see when it comes to their fair value estimate, they both do have upsides. So they both are somewhat undervalued, but BDX has much greater upside relative to its InvestingPro fair value, and so therefore it gets undervalued, whereas Altria, while still has decent upside, is within more of the fair value range, but on the more undervalued end of that. Analyst upside, they both trade quite closely to their analyst consensus estimates, but both do still have some upside there. Altria is considered to have better financial health, also has a much higher dividend yield, and when we look at the RSI, its RSI is much more attractive at just 39.47 than 63.55 for BDX. And RSI simply just shows how the market sentiment's fluctuating on it and if it looks like market is panic selling it or not. Okay, the last thing I'm going to look at here is a thing called WarrenAI, which is basically just a InvestingPro focused ChatGPT that you can go in and converse with it, and it'll output all this really cool information that helps you analyze the stock. So basically, what I'm going to look at here is I gave it this instruction: provide a comprehensive comparison of Altria and BDX in terms of their valuation, fundamental strength, and dividend growth and sustainability. And so it gives me a quick summary. Becton Dickinson is much higher fair value upside based on the InvestingPro model versus Altria's, which we already talked about. That said, Altria's dividend yield is high compared to BDX's. Now, the fluctuating number depends on if you're looking at the forward yield, the backward yield, et cetera. And so Altria's is going to be between 7 and 8%, depending on which exact way you look at it. BDX's is 2% or a little bit higher. But the real story is, in other words, Altria's dividend is about 3 to 4 times higher than BDX's is. But the real story is in their wildly different growth profiles and payout risks. And so then he compares them. This WarrenAI app compares them. So Becton is more undervalued on a fair value upside. It has a slightly higher PDE and EV to EBITDA, but that's because it's expected to grow much faster. As you can see, Altria's top line is actually shrinking due to the volume shrinking in its core business, whereas BDX is growing quite rapidly. We also see the payout ratios are both, pretty decent, but BDX has stronger dividend growth. This is wrong for Altria. It should be, it's a Dividend King, so it should be over 50 years. I think this is just a glitch by the AI here, or somehow they have some data that's silly for them. And then, so we see that, and then we also can look at their stock price momentum here and see how that's been going recently. This is why MO has a more attractive RSI, because you can see the stock price has been performing more weakly lately. We can see the revenue growth trajectory. Again, Altria's has been hovering around 0% for a long time, including some negative years, while BDX's has been gradually accelerating, as you can see there, and that's also picked up in the analyst estimates. We already talked about the yield, and so here we see that Altria is more attractive for income-focused, yield hunters who are willing to take on the risk of operating in a declining industry, the smoking industry, whereas BDX is more of a long-term grower and compounder for investors who value stability, even if the upfront yield is lower. And so when you compare these two, I would say if you are a young investor who's not planning on living off of dividends in the near term, and you do not implement a opportunistic capital recycling program using high yield stocks like we do at High Yield Investor, if you're not that, you're more of a buy and hold person, I think BDX is the more attractive opportunity right now. Whereas if you're simply a retiree looking to live off of dividends, and or you focus on stable, high-yielding stocks that you buy and sell opportunistically based on their valuation to optimize total return profile, I would say MO gets the edge here. But ultimately, I think both are probably, I would be neutral to slightly bullish on both of them personally. I do not own either of them, but I don't think either of them are bad buys right now. So again, hopefully that was useful to you. If you like this sort of content, like deep dive analysis like this, or also I provide regular macro analysis, I do portfolio strategy, I do ETF analysis as well. Subscribe to my channel for more content like this. I put out several videos each week. Also, please like this video to help its distribution. And last but not least, I encourage you to check out InvestingPro. They have a really great Black Friday sale going on right now, which is 55% off, plus an additional 15% if you sign up through my link, in which you'll get a coupon automatically added to your order. So please check that out. It's linked in the comment section as well as in the pinned comment at the top. And also, again, just a reminder, you can get my free list of Dividend Kings through the link in the video description as well as in the pinned comment. Thank you so much. See you next time.